Welcome to our Emerge video series. In this episode, Stewart CEO James Rhee shares his advice for brands looking to build a strong internal culture that leads to maximizing profits and satisfying customers. James, can you describe the Ashley Stewart brand for us before you became CEO?
All right, here's the good news. The brand was always a great brand. It always stood for friendship and loyalty and fashion and fun, right? And it always sold, plus-size clothing to women who wanted to be confident and to embrace themselves. The bad news when I first got down as CEO was that the company was broken and the company was insolvent, and that's why I resigned from the board to try to preserve as much of the company as I could. It was supposed to be for a very short time. It didn't end up being here. It's 3 years ago at this point.
Wow.
So there was a big difference between the brand, which stood for all of these transcendent great things, but the company that it was housed in was broken and obsolete. And as you know, we didn't have Wi-Fi when I first got there. That was the technology stack we were dealt with, and we were on a defunct ecom platform, and it had lost money for the last 10 plus years, losing $6-7 million a year, and that was the state of the company.
Okay, so James, coming into a broken house, as you just said, what did you do first?
Looking back now, I think people were pretty alarmed about it, but I told everybody that I'd never run a retail business before. As you know, I'm an investor by trade. Right. So I told everyone that these were the reasons why I loved the brand, that I was coming from Boston because I didn't want it to go away. And that I needed help, and that I was on paper arguably the least qualified person to run the company. I spent 6 months studying the math, studying everything, the business, but I think the most important thing that I did was to reestablish a culture that was based on merit, and that I wanted the brand to inspire the employees as much as the brand inspires its end customers for the last 20 plus years, and that I told them that one day that they would be very proud to work at this company. There was a lot of people that emerged from recesses of the building that said, I'll help you. And so we built a culture and a team based on a lot of adversity, and we didn't really care that everyone was betting against us. We just said that we were gonna do this and we were gonna emerge.
You talked a little bit about the culture there. So you had an old culture and you obviously brought in some new people. How did you merge those two cultures?
I told them that one day they would describe this company as a fashion company that was a technology leader run like a hedge fund with a mission, and that was the only way that I was going to be able to describe the culture. And people didn't understand it. Right. I just said, you'll understand it at some point. When I go into situations that require a lot of change, I don't dictate. So I listen a lot, and I try to do what a high school teacher would do, is saying, this is the core values of this brand. Do you agree, right? And how are you going to help us create a company that really, just amplifies the core values of this brand? Because if the business model doesn't amplify a core value of a brand, it won't work. So the culture had to be one that was fast, innovative, fresh, fair, fun, and that is the brand. So the culture has become that.
What advice would you give other retailers that are looking to reinvent themselves or re-emerge?
Whenever I invest in a company, I always ask myself, when the founder founded this brand, what was the impetus? Think about that founder. No one is backing the founder, and he or she is saying, I'm going to do this. So what was it? Number two is that I focus on the math. I'm an investor, so I crunch all the numbers and I figure out how do you affect what the mission is mathematically. And then the third thing is the people. You have to be able to, when you're trying to affect massive change, you have to be able to not only come up with a great business strategy, but take the time to explain why, and to all of your employees and colleagues, and say, this is why I believe this. Do you have input? Would you please co-author this plan? And then you have to have a great teaching culture, and people have to be really confident that they can't get in trouble on asking questions or disagreeing. And when things are in bad state, people are scared, right? They're scared for obvious reasons, and people generally don't trust each other.
You guys are our poster child for inventory management. Talk to me a little bit about how you use data to manage that inventory.
All right, so this is a fun question, so I get to put on my pure math private equity hat on now, right? So we run our inventory like I would run a bond portfolio, right? So it's being run like a hedge fund, and instead of margin and inventory, the way we look at it, and this is what's key to our success, it's run like a portfolio of bonds, and the margin rate is my yield. And so what we've done is created a set of portfolio math that maximizes my yield on my bonds by shortening the duration of my bonds. So said in inventory terms is that we're turning our inventory really fast and we're maximizing the velocity of cash, and that's why we keep the units very tight. The proliferation of inventory, it's like holding a bunch of bonds and not knowing it's yield to maturity, right? So if your bond duration is long, so we much rather would keep our bond duration short and maximize our yield that way, and then we can replenish the investment quicker. And so we're doubling our cash every 8 weeks. That's how fast the inventory is turning.
Right.
That bond math is something that very few retail businesses look at it that way, and they should be. And I've tried to have a lot of the management teams that I've managed as a board member look at it like that. But it's obviously a different way of thinking, and that's why from your earlier question about how do you succeed, you need to have people with different backgrounds teaching each other. And so in some ways my bizarre background it was helpful for the situation, right?
What other ways have you leveraged the data to manage the business?
There's not a single number that's not put through a return on capital test. That includes payroll, marketing expense. Again, we never look at sales. We always look at it as if you were investing money. So I'm investing money in a person or in marketing spend or product. Everything has a return. So that if the money is spent, the money has to come back, and you have to figure out how much money you're getting back. It so happens that my philosophy of business is that culture and decency and ethics, I firmly believe, do translate into better returns so long as the business model and the math are correct. You attract better people and amplifies your strategy.
How do you and your team stay on top of what's going on in logistics and fulfillment?
My job is to predict trends in everything, right? And so with logistics, it's a major cost center for us, but more importantly, it's the last touch to our consumer. So anything, again, that's important to our customer, it's like the furniture delivery business. They don't remember buying the mattress, they remember who put the mattress in the house, right? So we focused on it early, and it wasn't something that we said, hey, it's the finance function or logistics function. I was in every important logistics meeting from the get-go, because part of building a great e-com business is the customer service, right?
Exactly.
And so we had to choose that correctly. And I know that from our customers, by choosing the logistics partner correctly and having the pricing be fair, it's really impacted every part of our business. Our call center satisfaction is much higher. Our call center costs are much lower.
James, as we wrap things up here, what advice do you have for e-commerce companies that are either emerging or re-emerging?
You have to focus on your gross margin and IMU product structure. So most e-com businesses, they're very fast on developing a great paid search campaign and email acquisition, and they're great marketers. You fundamentally will have a difficult time making money in the long term if your IMUs do not sustain a plus 50% margin rate, unless you are trying to compete against Amazon and Jet and having lower margins and having massive scale. If you have massive scale, if that's what you want, then you have to raise a lot of capital. And for me, over the years, I have never been a fan of being beholden to anyone to give me money, right? So it generally doesn't work well. The second thing is on inventory management. A lot of the focus with e-com businesses, because again, it's a vicious cycle. To raise money, people focus on sales. And the money is generally from venture guys, not from more private equity guys like me, and they want to see sales and market share gains. And I understand that. So the focus on sales leads to very poor return on capital metrics, so that inventory is given short shrift because no one's looking at the balance sheet, no one's looking to see what your return on capital is. They're looking for your sales. So it creates an incentive to build up your inventory and just sell as much as you can of it at whatever margin rate, and rationalize and say that we've acquired customers and we need more money to be, but it's a vicious cycle, because if you're doing that, you're not making money.
Right.
So fundamentally, that's what I say to people, is that you cannot build a long-term business if you want to be sustainable. You got to make money. To do it, you need the correct IMU and margin structure, and you can't raise venture money and use it to buy customers, because ultimately your CPAs won't be able to justify the capital raised. I've said that like a broken record many times, and that's why fundamentally I believe that most businesses, unless you are of a scale of Amazon, you do need stores. True. And that's a whole different conversation, but when we were going through tough times at Ashley Stewart, when I had to put it into bankruptcy when I first joined, most people interested in the brand wanted to shut down all the stores. And I told them that I thought that was a mistake, but that was their decision, but I wouldn't be a part of it. I had no interest in being part of that. And so we fought to keep the 90 stores that we kept. It was a very unpopular decision, but nowadays there's a reflex, right? So you have a lot of startups now saying, oh, we should open up stores. It's not just for consumer engagement, but the pure math of making money in this industry, the margin rate, the margin productivity of stores is just superior. It just requires more capital up front. People say, what is your strategy with Ashley Stewart? I tell them, my job is to be her best friend. And if she views this company as her best friend, and I'm the CEO of the company, so my job is to know her better than everybody, right? To be her #1 advocate. It doesn't matter how big the company is, it's more I want people one day to say that business, they know their customer better than anybody, and they're more beloved by their customer than any other business I've ever seen. So if we can achieve that, to me that's success, and I know that the numbers will be there.
To get more information about how you can grow your online business, visit www.dotcomdist.com.